Sole Prop LLC S-corp election. Entity Structure Module 7. Before anything else, a reminder from Module 1. Niche, offer, demand, sales, and ethics are the 5 decisions that determine whether your practice builds. Entity structure is backbone. It holds the practice up. It does not do the building for you. We're here because a poorly designed backbone creates unnecessary friction for everything else, not because this is the most important decision. Picture a coach 18 months in, $60,000 in annual revenue, sole proprietorship. Their accountant says, you need an LLC for liability protection. A coach friend says, S-corp is where the real tax savings are. A Facebook group says, don't do anything until you hit 6 figures. All 3 are partially right. All 3 are mostly unhelpful. Here's the framework that actually decides it. The backbone distinction from Module 1.1.3, niche, offer, demand, sales, and ethics are the 5 decisions that determine whether your practice builds. Operations and finance are the backbone. They hold the practice up, but they don't do the building for you. That distinction matters here. Getting the entity right doesn't substitute for getting the niche right. Keep that in proportion as we go. Here's the collapse that causes most of the confusion. There are 2 completely separate questions that coaches routinely treat as one. The LLC question. Does your coaching practice create legal exposure you want to keep away from your personal assets? That's a liability question. The S-corp question. At what revenue level does electing S-corp taxation produce net savings? That's a tax question. Different axes, different answers. Answering one doesn't answer the other. What an LLC actually does, specifically. An LLC is a state law entity. It creates a legal boundary between business liabilities and personal assets. If a client dispute, contract claim, or negligence allegation goes legal, the LLC keeps it away from your personal bank account. What it does not do: change your federal tax treatment. A single-member LLC is a disregarded entity by default for IRS purposes. You file Schedule C. All net income is subject to self-employment tax, exactly like a sole proprietorship. The LLC may have been the right move for liability reasons. But if you don't know that's what you got, you don't know what you bought. Knowing what you bought is operator discipline. State matters concretely. A coach in California setting up an LLC pays a minimum $800 per year in franchise tax to the state regardless of revenue. At $30,000 in revenue, that's 2.7% of gross before a single deduction. Not catastrophic, but not free. Worth knowing before you file. A coach in Texas pays no state income tax and no LLC franchise tax until revenue clears $2.47 million. Same business structure, materially different cost. New York City coaches face the unincorporated business tax on sole props and single-member LLCs operating in the city. A specific gotcha worth flagging. The entity decision includes a cost of state component. Here's the state-by-state picture for reference. Texas, no state income tax, no LLC franchise tax until you clear $2.47 million in revenue. California, $800 minimum franchise tax per year regardless of revenue, plus a gross receipts schedule above that. New York City, unincorporated business tax applies to sole props and single-member LLCs doing business in the city. Florida, no state income tax, low LLC formation cost. Same business structure, 4 different cost profiles. The table on your screen is the reference. We're highlighting the ones that move the decision. One more concrete number before we move. A California coach with $30,000 in revenue paying the $800 LLC minimum franchise tax is paying 2.7% of gross revenue before a single deduction is taken. That's not a reason not to form an LLC in California. If the liability protection is warranted, the cost is real but manageable. It is a reason to make the decision knowingly, rather than because someone in a Facebook group said you should. Self-employment tax, the mechanic. This is the number S-corp election is working against. Under sole prop or disregarded entity LLC, all net income is subject to SE tax. 15.3% on the first $168,600 in self-employment income in 2026 and 2.9% on income above that threshold. The tax base is 92.35% of net income. The calculation accounts for the deductible half of SE tax before computing the base. That's the IRS Schedule SE logic. The S-corp question is whether the savings from reducing SE tax exposure beat the cost of running the more complex structure. S-corp election. What it is and what it isn't. S-corp is a federal tax election, not an entity type. An LLC can elect S-corp taxation. A C-corp can elect it. The election changes how the IRS treats your income, not what kind of entity you are. Under S-corp election, you pay yourself a reasonable salary, subject to payroll taxes. Distributions above that salary are not subject to self-employment tax. That's the savings mechanism. The IRS requires the salary to be reasonable, market rate for the services you're actually providing. Setting a $1 salary to maximize distributions is a known audit trigger. Courts have collected significant back taxes and penalties from coaching-type service businesses via exactly this route. Set the salary honestly. Pause here. Pull out however you track your revenue. A spreadsheet, your accounting software, a napkin. Write down your gross revenue for the last 12 months. That number is the input to the S-corp break-even calculation we're running in the next video. Don't wait to look it up later. Write it down now. Here's what you now have. LLC and S-corp are separate decisions along separate axes. The LLC is a liability decision, a state law entity. The S-corp is a tax decision, a federal election. A single-member LLC is a disregarded entity by default. Your tax treatment doesn't change until you elect differently. State matters. California has a real cost. Texas and Florida are favorable. New York City has a specific gotcha for sole props and LLCs. Self-employment tax is the number S-corp election works against. 15.3% on the first $168,600 in 2026. The break-even math is the next video. Bring that revenue number.